Hi everyone, I hope you guys are doing good. Today I have come up with another video, and this time the topic is a bond. Um, this is basically the video that comes next in the series that we started on the investment banking and capital markets. Right, so let's try to understand what is a bond. It's one of the most popular fixed income asset class products. Um, it's basically a security that is being issued by the governments, corporates, or municipal corporations. And the purpose of doing that is to raise money. It's less risky. So the risk with a bond associated is less as compared to equities, which is a highly volatile market, right? And as I've already mentioned, you get interest, which is also called as coupon, and that is generated and provided to the investor at a fixed defined frequency. Now, remember, there are a couple of things that I wanted to mention here. In the last video, if you see on the investment banking, I talked about the buying side and the selling side, right? So just put that same concept back on the table. And if there is a bond, there is somebody who has issued a bond, right? And that person is basically the issuer of the bond, which in this case can be a government or corporate or the municipal corporation, right? Now, who is going to buy the bond? Right. So the bond would be bought by maybe ordinary people if they are investing in the bonds, or there could be some pension funds, for example, right? Or it could be some other fund, some other investment fund. Um, I'm sure many of you invest in funds. Now, what happens is when you put the money in the funds, the fund manager would in turn then take that money and invest into a certain set of asset classes, depending upon the nature of the fund. If it's a fund that's highly risky, then obviously the percentage of the equity exposure is more in that fund as opposed to the fixed income. And vice versa. If it happens to be a risk averse fund, then you would see the percentage of the fixed income composition more in that particular security, right? So that's basically how it works. So let's look at some of the basics here of a bond, right? As you can see on the screen, I have taken a nominal $100 bond, nominal value worth of $100 bond as a sample, and you can see that it's a 3-year bond, right? It starts from the inception and then you redeem at the end of the 3 year. Basically, the issuer is going to buy back the bond and you get the money back. Right now, you can see that the coupon, which is the interest that you get, whatever the percentage that's fixed, that's going to be paid to you every 6 months, right? So you can see that the coupon gets paid to you 6 times over the period of a year if you hold the bond for 3 years until maturity, right? Now the market value of this bond can actually change. So what can change the market value? A lot of factors. If the bond is popular, if the bond is doing good, then it could be a case that the bond would then be bought by many people, and in which case you would see that the bond would have a price that is more than the nominal value of the bond. So the bond could be trading at say $110 instead of $100. Or vice versa, it could also be a case that the bond is trading at a discount, basically. What it basically means is it's trading at a value that is lower than the nominal value of the bond, $100. So it could be trading at, say, $90, right? And that's where your capital gain and loss factor would come into picture. So remember, let's try to understand it very, very simply, right? You invested an amount worth of, say, $100. You get the coupon every 6 months. It's a 3-year bond. So the maturity is 3 years there, right? Now, if it so happens that the bond has traded at a is trading at a price that is more than the nominal value, then obviously if you buy the bond say for $110 instead of $100, then that means that you are paying more than the actual value of the bond. And in which case, when the bond matures and when the issuer is going to buy back the bond, he is going to buy it back at $100 itself. So right, so you lose that $10 over there as the price, and that $10 is what you need to factor in during the course of you holding the bond. I mean, and when you calculate your gross yield, that is when this will come into picture. Now let's look at some of the terminologies that I wanted to cover here. Nominal value, as I told you, it's the face value of the bond. Coupon is the interest that's received on the face value. The market value is the current price at which the bond is trading. These are all self-explanatory terms, so there is no confusion there. Income yield, that's a new one. So what is yield here? So it's basically how much has um, been, the income that has been generated on that particular bond. So it's an annual income return as a percentage of the price of the bond. And what is gross yield return? It's the income yield plus capital gain loss that I just discussed. So the total annual income is a percentage of the current price of the bond. Now, duration. What is duration? So duration is basically how sensitive the bond is to the interest rate changes. How sensitive the price of the bond is to the interest rate changes. Now, typically, if the bond has got a higher duration, it's a number basically. So if it's a higher duration, then that basically means that it's a risky affair to go with that bond because it's highly sensitive to the interest rate changes, right? So now remember, how this works is that let's say that you have a bond which has a maturity of, say, for example, 20 years or 25 years, right? It's a long period of time. So even though there would be a price movement on that bond, um, you know that the price movement is okay. I mean, you know that the price movement is going to be there, and there would be ups and downs throughout because it's a long duration, right? It's 20 to 25 years of the time period that you're looking at. Now, compare that with a bond which has a maturity of say 1 or 2 days, right? So even though you say you buy that bond at $105, for example, and if it's $100 nominal value bond, you know that there's not going to be much movement in terms of the interest rate changes, for example, right? Because the maturity is coming pretty soon. It's going to be mature in 2 days, and you kind of know that you will get your $100 back, from the issuer. So that's how you have to understand duration. I'm not putting any mathematical formulae or anything of that sort here. But if any one of you is, say, for example, intending to do a CFA or an FRM, these kind of certifications, or is completely into these kind of things in detail, then obviously, right, you can actually do some more research, or I can come up with a short video where I can cover some of these basics, and we can we can talk about some of these things. But the intent here is to keep it very, very light so that it basically is understood by majority of the people who are watching this video. Now, what is price versus yield? So it's a very, very simple philosophy that the yield is inversely proportional to the price. So what happens is, let's assume that there is a bond which is actually having a coupon of say 5%, right, or interest of 5% paid to you annually. Now, if it so happens that you hold the bond, and in the meantime the market is actually doing very well, let's say there is a new government that gets elected in the country, and all of a sudden you see that the market is performing exceptionally well. There are changes in the interest rates as well. Now, the interest rate, if it goes up, right? If it goes up to say 7% or 8%, highly unlikely though in these kind of times, but say it goes up, say 8, 9%, that sort of range, then why would you invest in a 5% bond, right? So, in a bond that gives you 5% return. So, in that case, the price of the bond is going to come down because less people are going to be invested in this particular bond, and vice versa. If the market crashes for some reason, but the bond has a fixed interest that it's going to pay you as a 5%, and say the market is giving you only 2%, let's say they keep the money in the bank gives you only 2%, you wouldn't be keeping that money in the bank, right? Because obviously bank is giving you lesser return as compared to another option which you have, which is also a secure option, and therefore the price of the bond may go up. So that is how you have to understand the price versus yield uh, relationship. Now, why bonds? Very, very simple. I mean, I don't think I need to go over this slide in detail, but just for the sake of going over and summarizing it, it's less risky as compared to equities. It helps you to diversify your portfolio. You may be going through this video for for an understanding of fixed income asset class or a bond for your project work. If you're working in IT projects, for example, maybe you are in working in a production support environment, or maybe you're working in a development environment. Um, but at the same time, you may also be an investor personally, right? So you want to diversify your portfolio. You want to keep your money into different asset classes so that your risk gets mitigated, right? By the way, just a disclaimer: this isn't any financial advice of any sorts, right? I'm not a financial advisor. This video is only intended to share some knowledge about bonds. So bond is basically a product that will help you to diversify your portfolio. So if you have a high equity exposure, you may want to complement that with a good mix of bond and less risky securities, so that in case if the equity market crashes tomorrow, the bond is there to take care of and hold the strings together. It gives you regular income. Um, we have already discussed about it. So you get your coupons at a fixed defined frequency, and it also gives you better returns than cash. If you like the video, please give it a thumbs up and let me know what additionally would you like to see. So thank you very much for watching the video. Take care. Bye bye.